Hello everyone. The year 2017 for the fixed income markets began on a positive note with, I would say, renewed optimism, which was a continuation of the year 2016. However, the February monetary policy actually applied some abrupt breaks, if I were to say, into the bond markets, where the central banker moved from the accommodative bias to the neutral bias. So it's not so much of the status quo which took the markets by surprise, but more the gear change from accommodative to neutral bias, which caught the markets by surprise. And intuitively, we saw a reasonable sell off in the bond markets, with the yields going up almost 0.4 to 0.6% across various tenors. Currently, as we speak, the 10-year benchmark government security yield is approximately at 6.9%. But the rest of the yield curve, which is the 12-year, 13-year, and the rest of the segment, is way beyond the 7% yield mark at about 7.3 to 7.4%. The corporate bonds, of course, did not see that kind of a significant sell-off, which basically entrenches our belief that accrual funds, even in this kind of a market scenario, which an accrual fund essentially means a fund which is largely overweight corporate bonds of varying maturities, typically the shorter end, and of course various varying rating profiles, is a strategy suited well for even these kind of market conditions. The good news amid this so-called gloom, or I would say the near-term gloom, is that liquidity in the banking system continues to remain favorable. The yield curve on the day of the monetary policy at the shorter end vis-a-vis today is visibly lower, and that clearly has been aided by a comfortable liquidity in the banking system. The overnight repo or the benchmark repo rate being at 6.25%, the daily transactions, which is the overnight or the CBLO market as we call it, has been hovering for a fairly long period of time at about 5.7 to 5.75%, which has allowed for the yield curve up to 1 year to show a meaningful visible lowering down of the sentiments and lowering down of the yields. What do investors do from here on? So there are two ways to look at it. Firstly, for those who already have positions in long duration funds like gilt and bond, irrespective of whether or not one has completed 3 years, we believe should stay put. These may not be the levels to either book profits or to exit such investments in a haste. For those who are planning fresh investments into fixed income at the current levels, say assuming a 100 rupee portfolio right now, we would still recommend what we have been stating for a fairly long period, that you should be around 80 to 85 rupees of the 100 rupees into a short-term stroke and accrual based strategy, and the remainder of 10 to 15 rupees still should continue to find favor with long duration funds. Those would definitely be a tad more volatile, but imagine this is a kind of scenario where you have got I would say unusual period rains, so you would obviously want to equip yourself with some rain gear, and that is the reason with a higher shift towards accrual stroke short duration you would be able to achieve that objective. Ultimately, any investment in fixed income would still be recommended with a 3-year investment horizon to be able to get better risk adjusted and tax adjusted returns in your favor. In conclusion, we believe that these have been certain knee-jerk reactions to the market in terms of the credit policy events, monetary policy events. We therefore urge you to stay belted, stay a little bit calm, because at these points in time is when there are tendencies to make a little bit of mistakes from an investor or from an advisor standpoint, and we should clearly step back and try to probably assess the macro in the light of which we took an investment decision before taking the next move forward. This being the month of Holi, wish you all a very, very happy, festive and colorful Holi. And I would urge you all to look at investments in the light of this colorful festival, where it is natural sometimes to get a little bit wet, especially when you play with water. But obviously the thrills of being participating in this festival is truly delightful. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.